Recent US-Israel-Iran conflict has brought Iran's inflation crisis back to the public eye. Surge in inflation and sharp currency depreciation have contributed to widespread social unrest, highlighting the severity of the country's economic challenges. However, persistent inflation in Iran is not a new phenomenon. It has long been a structural concern for economists. In my essay, I examine three key vicious cycles that underpin Iran's inflationary dynamics, drawing on established economic theories and supporting them with empirical evidence to explain why inflation remains both persistent and difficult to stabilize. This vicious cycle relates to inflation expectations and poor central bank credibility. The cycle starts with a cost shock, such as currency depreciation or sanctions in this case, which raises Iranian firms' costs and shifts the price setting curve downward. This creates a bargaining gap, as workers demand higher wages to maintain purchasing power, while firms cannot afford them. Firms respond by raising prices, leading to higher inflation. As inflation persists, expectations adjust, with workers and firms anticipating further price increases. This shifts the Phillips curve upwards, generating even higher inflation. The process then feeds back into itself, creating a self-reinforcing loop in which inflation drives expectations and expectations drive further inflation, as explained in this graph. In economies with credible central banks, this kind of inflationary loop is usually contained because inflation expectations are anchored by clear policy targets. However, in Iran, low policy credibility and limited central bank independence mean that expectations are not well anchored, making it much harder to stabilize inflation once the cycle begins. The second vicious cycle in Iran is driven by an imbalance in the foreign exchange market. On the supply side, sanctions restrict access to foreign currency by limiting oil exports and freezing overseas reserves, reducing the inflow of US dollars. This shortage is worsened by Iran's fragmented NEMO exchange rate system, which further contracts dollar liquidity. On the demand side, persistent depreciation of rial erodes confidence, leading households and firms to shift into foreign currencies and gold as source of value. As expectations of further depreciation rise, demand for dollars increases even more. These forces create a self-reinforcing cycle. Limited supply pushes up the exchange rate, causing further depreciation, which in turn increases demand for foreign currency. This mechanism helps explain the sharp fall of the rial in January 2026, when tighter sanctions and rising uncertainty triggered a surge in dollar demand and rapid depreciation. A third vicious cycle in Iran is driven by the interaction between debt dynamics, risk premium, and monetary expansion. In a high inflation and unstable environment, investors demand higher interest rates to compensate not only for inflation, but also for expected currency depreciation and risk. As a result, borrowing costs rise significantly, with policy rates around 23% and bond yields even higher, increasing the government's debt burden. However, due to sanctions and an underdeveloped financial system, demand for government debt remains limited. At the same time, persistent fiscal deficits, around 4 to 6% of GDP in recent years, force the government to rely on monetary financing. This expansion of the money supply fuels inflation and weakens confidence in the rial, leading to further depreciation. As expectations of depreciation rise, investors demand even higher returns, reinforcing the cycle. Ultimately, this again creates a self-sustaining loop of rising interest rates, currency depreciation, and persistent inflation. Therefore, my conclusion is that looking ahead, the ongoing war is unlikely to ameliorate these dynamics. Instead, it will worsen foreign exchange shortages, increase uncertainty, and raise government spending, which will place further downward pressure on the rial, pushing inflation higher and making expectations even more unanchored. As a result, inflation is likely to remain elevated and potentially become more volatile in the medium term. Without credible policy reforms or an improvement in external conditions, Iran is likely to remain trapped in a high inflation environment with limited ability to stable prices and restore macroeconomic stability.